Welcome everyone. If you have ever wondered how companies record mergers, acquisitions, takeovers, or even reverse listings, then today's session is for you. Because Ind AS 103 is the backbone of business combination accounting. It tells us how an acquirer recognizes and measures the assets and liabilities of another company and how goodwill is calculated, and when a gain on bargain purchase arises. From step acquisition and reverse acquisitions to common control, mergers, and restructuring, this standard covers it all. And don't worry, I will explain it in the simplest and most practical way, with clear examples and journal entries, so that both students and professionals can apply it confidently. So let's start this powerful journey in understanding Ind AS 103 business combination. The key topics that we are going to cover today are the objective and the scope, the definition of the business and identifying the business combination, what is the acquisition method, what are the recognition conditions, concept of bargain purchase. We'll touch base with acquisition through stages and when can acquisition happen even without consideration. Common control business combination, which is normally known as pooling method, subsequent measurement, reverse acquisition, presentation and disclosures, and followed by comparative analysis with IFRS 3. So let's begin this journey and move to the first slide. Okay, now we'll quickly talk about the objective and the scope of Ind AS 103. So if we talk about the objective, so Ind AS 103 prescribe how an acquirer recognizes and measures the assets and liability and non-controlling interest of the acquiree. So which means that Ind AS 103 is for the acquirer. The entity has to ensure that the assets and liabilities which has been acquired from the acquiree are recorded at a fair value. That is the basis of the accounting of Ind AS 103. It should ensure that true reflection of the acquisition economics and definitely the comparability with the IFRS. So this is the objective of the Ind AS 103. And when we talk about this scope, so it includes largely the four kind of the acquisition, which is the acquisition of the control of the business. It includes the step acquisition, which is like acquisition in multiple stages. It includes the reverse acquisition, and finally it includes the common control combination, which we normally called as pooling of interest method. But it excludes the acquisition of assets only, which means that if an entity just acquires the asset without the actual resources, it excludes that because it is simply asset acquisition, joint arrangement, and a business combination under the common control are treated separately. So if we look at the entire objective in this scope, so objective is to ensure that accounting is properly happening in the book of the acquirer when it acquires the business of another entity, ensures that it is reflecting the true and the fair statement of affairs, and scope includes largely the four type of combinations, which is the acquisition, complete acquisition in one go, step-by-step acquisition, reverse acquisition, and pooling of interest method. So we'll move to the next slide. Okay, now the key definitions that we should be aware of before we proceed further for understanding of Ind AS 103 is the two definition, which is the definition of business and what is treated as a business combination. Now, when we talk about the business, an integrated set of the activities and assets that is capable of being conducted and managed to provide a return to the investor of the other economic. So which means that it has to be a business acquisition. It's not like if entity has acquired some of the assets of another entity, then it can be treated as a acquisition of business. It's not like that. When we are acquiring the assets, it's like simply asset acquisition rather than the applicability of the Ind AS 103. To make sure that Ind AS 103 is applied, it has to be business acquisition. And business acquisition arises when there are acquisition of the inputs, acquisition of the process, and then definitely those inputs and process are used to produce the outputs. So when we talk about the inputs, inputs are the resources that create the outputs, like asset, employee, system. Processes are the systems, methods, or the activities that convert inputs into outputs. So a set must include at least input plus processes. Outputs are not mandatory, but the capability to produce the output must exist. So which means that the kind of the resources that we are acquiring and the kind of the assets that we are acquiring and the processes that we are acquiring, that ensures that the entity is going to use that resources to produce the output. So this is the major differentiator between the asset acquisition versus the business acquisition. Now, when we talk about the business combination is what? It's a transaction or other event in which acquirer obtains the control of one or another businesses. The acquirer obtains the control, not just assets. So, which means that control has to be there. The definition of the control is the definition which is there in the Ind AS 110. The control means the control over the affairs of the organization, not just the acquisition of the assets. So it includes the input, includes the process, output is accounting method. If it is an asset acquisition, it is Ind AS 1638 or 109 as the case may be. But if it is a business combination, then Ind AS 103 applies. So differentiator for the application of Ind AS 103 is the kind of acquisition that we do. If we are doing the assets acquisition, then if it is PPE, it is Ind AS 16. If it is intangible, it is Ind AS 38. Or if we are, acquiring any financial instruments, then it is Ind AS 109. But when we are acquiring the business as a total, then it has to be Ind AS 103. Goodwill is recognized only when it's a business combination. It is not recognized when we are doing the asset acquisition. So we have created a table here for the easy understanding. So if scenario is the purchase of only the land and building, it is a business? No. Treatment is asset acquisition. Purchase of the running factory with the employees in the process is a business combination? Yes. Acquisition of the customer plus contractors worker is a business combination? Yes. Transfer of only equipment? No, because it's an asset acquisition. So a business under 103 is an integrated set of the inputs and process capable of producing the output, and a business combination occurs when an acquirer obtains control over the such business. These are the ingredients of a business combination, and business has to be there. Then only we can able to apply Ind AS 103, and then we ensure that post application of Ind AS 103, all the entries are recorded, considering the fact that it is a business combination, and resultant goodwill will be accounted or capital reserve will be accounted as prescribed by the Ind AS 103. So we'll move to the next slide. Okay, now having understood the concept, objective in the scope of Ind AS 103, and then having understood the concept of the applicability that it will only record or arises when we have a business and business combination. Now we'll quickly talk about what is the definition of acquisition. Now, when we talk about the acquisition, so acquisition as per Ind AS 103 arises. Which means when we are acquiring the business, then it has four stages. So, what are those four stages? First of all, we have to identify the acquirer. We have to determine the acquisition date. We have to recognize and measure the identifiable assets and liabilities. Then we have to recognize the goodwill or the bargain gain, bargain purchase gain, which is nothing but the capital reserve. Now, stage one is identify the acquirer. The acquirer is the entity that obtains the control defined as per Ind AS 110, as we mentioned in the last slide. Company A acquires 60% share of the company B. So, in this case, A is the acquirer. Stage two is to determine the acquisition date. And this is the date when the control passes to the acquirer and is important because fair value are determined at this date. And this is most important because whenever it is being acquisition in stages. So Ind AS 103 applies only when the control passes. And then we have to ensure that on that particular date, we have to do the assessment of the fair value. And we'll talk about the entire accounting concept when we are doing the step purchases in the subsequent slide. Stage three is to recognize the identifiable assets and the liabilities. Recognize at the fair value on the acquisition date and includes the tangible assets, intangible assets, even if not recorded in the inquiry book. This is most important. So which means that even if it is not recorded in the inquiry book, we have to account for that at a fair value when we are doing the acquisition of the business. And liabilities and contingent liability are also recorded at the fair value. So quick example here. So in an acquisition, asset has been acquired with the book value of 100, and the brand, which is because it is the internally generated brand, it is not accounted in the book of the acquiree, but once we are doing the acquisition, we can do the accounting for that, and it has a fair value of 80, and the fair value of building is 150. So the total acquisition price, the net value of the assets that has been acquired is 150 plus 80, which is 230. Now, stage 4 is to recognize the goodwill or the bargain purchase. The goodwill is equal to the consideration transferred plus non-controlling interest plus fair value of the previously held interest minus the fair value of the net identifiable assets required. So simple is that we have a consideration of 500, net controlling, non-controlling interest is 200, fair value of the net asset is 600. So goodwill is calculated. We have to add the consideration plus non-controlling interest. Plus, we do not have any fair value of the previously held interest. This is normally happens when we do the step acquisition, and the fair value of the assets is 600. So goodwill is 100. So entry is identifiable assets, goodwill will be divided by 100 to liabilities, and the consideration payable is 500. So we'll talk about in more details, with more examples in the upcoming slide. But the concept here is that acquisition happens in the 4 stages. First, we have to determine the acquirer, identify the acquirer. Then we have to determine the acquisition date. This is most important date because this is the date on which the assets and liabilities would be recognized at a fair value. And then we have to recognize the goodwill, which is the resultant amount once we have the consideration amount and the net identifiable assets being available. Goodwill or capital reserve, that is the result. So we'll move to the next slide. Okay, now in any standard, the most important principles that we need to have understanding is the recognition and the measurement principle. So we'll quickly talk about the concept of recognition and the measurement with respect to Ind AS 103. So recognition principle is that at the acquisition date, the acquirer shall recognize the separately the identifiable assets acquired, liabilities assumed, and any non-controlling interest of the acquiree. An item is recognized only if it meets the definition of an asset and liability as per the Ind AS. This is normal. It is the part of what the acquirer and the acquiree exchange in their transaction. It can be measured reliably at the acquisition date, and special recognition rule applies to below. So, so typically, it's like when we are recognizing the assets and liability, it has to go by the fundamentals of the specific Ind AS under which that assets is being categorized. We have to make sure that acquirer and acquiree should have and the assets and liabilities as part of the transaction which has been identified by the acquirer and acquiree. It can be measured reliability at the acquisition date. That is most important, specifically for the intangibles. And the special recognition rules applies to below. So intangible assets recognized even if not recognized earlier. So we, in the last example, we have looked at that the brand which was not recognized because it was internally generated intangible. It was not recognized in the book of the acquiree, but it was recognized when acquisition happens. Contingent liability recognized if the present obligation exists and the fair value is measurable. Employee benefit recognized as per Ind AS 19. Indemnification assets recognized at the same basis as the related liability. So depend upon kind of the indemnification that we're going to have from the acquiree. So measurement principle is the acquirer shall measure the identifiable assets and liabilities assume at their fair value. This is most important. It has to be done at the fair value and not the value at which is being carried in the books of the acquiree. At the acquisition date, so two things are important here. The first is that it has to be recognized as a fair value, and second important thing, it has to be recognized or measured at a acquisition date. It applies to tangible assets, intangible assets, liabilities and contingent liabilities, non-controlling interest, and the but there are some exceptions. What are those exceptions? We'll look at it. But before that, we have to make sure that two important concepts on the recognition and the measurement principle is that recognition has to be at the fair value and measurement has to be at a acquisition date. That is hold more importance when if we are doing the acquisition on multiple days, because at one date we do not have the controlling interest, but let's say in the second or subsequent acquisition we have the controlling interest, then at that particular date is treated as the acquisition date and the fair value needs to be assessed at that particular acquisition date. Some of the exceptions at which the account or the recognition would happen: deferred tax would be measurement basis would be Ind AS 12, employee benefit obligation would be measured at Ind AS 19, share-based payment awards would be as per the Ind AS 102, reacquired rights based on the remaining contract term, and the assets held for sale are recognized as per Ind AS 105. So which means that though the measurement has to happen at the fair value, there are few exceptions. So deferred tax would be as per the Ind AS 12, employee benefit has to be at Ind AS 19, share-based payment has to be Ind AS 102, and we have to guided by the measurement criteria which is being applicable to the respective standards. And then once we have identified the acquisition date, we have to do the measurement accordingly. So recognition criteria and measurement criteria helps us to identify two important things. First, recognition has to be at the fair value, and secondly, it has to be make sure that the acquisition date should be the date on which measurement will happen. So this clears the concept of the recognition and measurement for Ind AS 103. So we'll move to the next slide then. Okay, now we'll talk about the bargain purchase. So bargain purchase is typically a situation when the consideration that has been paid for the net assets of the or net assets of the acquiree is less. So which means that we have paid less amount for the net assets of the acquiree, and this results into a capital reserve. So this is normally called a bargain purchase. So bargain purchase occur when the fair value of the net identifiable assets exceeds the consideration transferred or the NCI for previously held interest. The acquirer buys a business for less than the fair value. So the gain arising from the bargain purchase is recognized in the other comprehensive income and accumulated in the capital reserve. This is a key difference between IFRS, because in IFRS this is being done through profit and loss account. So this is one of the key difference when we compare to IFRS 3. So why does bargain purchase happen? So basically it's a kind of a distress sale, out of compulsion, forced liquidation, undervalued business acquisition, and a strategic exit by the seller. So any kind of situation wherein the acquiree wants to exit from the particular country, he wants to sell off the operation, or there's a tight situation, he wants to get rid of his business, or it's a forced liquidation from some order from the court or the regulatory authority. So all these situations would result into a bargain purchase, and the consideration paid is less than the fair value of the assets acquired. So which means that there is a profit to the acquirer, and that profit is nothing but the capital reserve, which is being classified under OCI. So bargain purchase is the gain, which is OCI treated as a capital reserve. Under IFRS, it is being treated as under P&L. Objective is because it's a conservative, it is we're not going to treat it as a profit, and in under IFRS it has the aggressive approach, and it is being impacting the profit directly of the acquirer. So we'll move to the next slide. Okay, now we'll talk about most critical and realistic aspect of the business combinations, which is acquisition is a situation when the acquisition happens to stages, and this is largely a practical scenario. So in business combination achieving status, the acquirer remeasures the previously held interest at the fair value on the acquisition date, because at the multiple dates shares are acquired. So which means that a date when the finally the controlling interest has been transferred to the acquirer, that is the date which is treated as the uh, acquisition date, and on that date the fair value assessment is going to happen, and we have to recognize any gain or loss in the P&L, and then applies the acquisition method for the entire combination in totality. So it's being done in the steps. So under the step one, what we have to do, we have to identify the acquisition date when the control is obtained. Step two, remeasure the previously held interest at the fair value. Step three, recognize the gain through the P&L. And step four is the apply the acquisition method to the full business combination. So these are the four stages in which the entire acquisition process is going to get wrapped up when we are doing the step when we are doing the accounting for the step acquisition or this acquisition through stages. So we have illustrated through an example here. So stage one is when ownership is 30% and the cost of the asset was 300, which is the carrying amount. Stage two, additional 40% of it, cost was 600. And in the stage two, the fair value was is at the acquisition date was 450. Now fair value of the net identifiable asset, it has been assumed as 1000. So what we have to do, we have to remeasure the previously held interest. So first, the because when we have acquired the early 30%, which was the first 30%, it was normally treated as the investment in associates and it was accounted at a cost, which is the equity method, and investment in the associate is 150. What was recorded at 300. Now, because the fair value has increased to 450 on the acquisition date, first of all, we have to revalue that particular asset to the fair value. So we'll debit the investment in associate, and the gain would go to my P&L. This is 150. Now, on the acquisition date, we have to recognize the full business combination. So consideration is the new purchase, which is 600. FV of the previously held interest is 450. Total consideration is 1050. Now, a fair value of the rentable asset is 1000. So fair value is 1000. We are paying 1050. So identifiable assets is 1000. Goodwill is debited with 50. Consideration paid is 600, and then previously held investment is 450. So accounting entry is making sure that we have recorded the identifiable asset of the acquiree at a fair value, which is 1000. The previously recorded investment of 300 that got increased to 450 by creating a gain in the P&L. And then once it has increased to 450, it was credited because the entire net assets is now being debited in my in the acquirer book of the account, and the goodwill, which is the resultant figure, which is 50, which is being balancing figure over the fair value versus the value at which it has been acquired. So fair value is not net is 1000, the total purchase consideration 1050, and hence the amount which is being transferred to goodwill is 50. This entry clearly illustrates the accounting whenever the acquisition happens at these stages. And this is the practical and the realistic example, because it has been observed that a lot of the acquisition happens over the period of time. So the most important point here is that we have to identify the acquisition date, because that is the date on which fair valuation of the assets and liabilities is going to get happen. And then that is the date on which accounting entry is also going to enter in the books of account. So we'll move to the next slide. Okay. Now we'll talk about a situation when there is a acquisition, but it does not have any consideration, and why it arises. We'll also look at that. So when a business is acquired without transferring the consideration, the acquirer applies the acquisition method and recognizes the fair value of the net identifiable assets required. So which means that even if the consideration has not been paid, still it is not impacting the way the accounting has to happen. The way the treatment has to be, it is the same treatment. Acquirer has to has to account for the assets and liability at the fair valuation date. And if there is no consideration, then the entire amount will be going to my capital reserve into my OCI. So resulting in the goodwill or the bargain purchase gain credited to the capital reserve. So, business acquisition without consideration occurs when an acquirer obtain the control of the business without transferring any consideration. So, if the acquisition of liability is more than the acquisition of the asset and no consideration is payable, then definitely it would result in the goodwill. But if opposite is there, my resultant assets are more than the liabilities and no consideration is paid, then it would be a capital reserve. So why this kind of a situation arises? Because if either is a legal restructuring is there, government has done some takeover, debt conversion into equity, court ordered the mergers or common control arrangements. So these are situations whenever the acquisition happens because of some order of the court, some compulsory acquisition, and in that case, even if consideration is not being paid to the acquiree, still we have to do the accounting as per the accounting method or the as per the prescribed method as per the Ind AS 103. Even when no consideration is paid, the acquirer must still apply the acquisition method. The fair value of the acquiree net identifiable asset is recognized, and the goodwill or the capital reserve is completed or computed accordingly. So this simply says that if even if we have acquired the business without consideration, it does not stop us to do the accounting as per the requirement of the Ind AS 103. So we have to apply the accounting as per the Ind AS 103, irrespective whether consideration has been paid or not. So I'll move to the next slide. Okay, now we'll talk about the pooling method, which is the method wherein the combining entities of business are under the control of the same parties, which is that a parent having multiple subsidiaries, they want to merge couple of their subsidiaries or parent having two subsidiaries, they want to merge their subsidiaries, then this is normally a pooling of interest method. So basically, what does this mean? That under the controlling the same party or the parties both before and after the combination. Basically, this applies to a kind of situation when the control under which is the common control is on the parties are same even before or after the acquisition, and that control is not transitionary. This is called a business combination under the common control. So this is a situation wherein it is no acquisition method is applied, no fair value measurement is done, no goodwill is recognized. So simple. So which means that it is not treated as normal acquisition, on which we have to do the fair valuation and on which the resultant goodwill or capital reserve would arise. So this in this situation, what we have to do, assets and liabilities are recorded at their existing carrying amount. It's very simple. So assets would be recorded at the existing carrying value. Liabilities would be recorded at the existing carrying value. Difference adjusted in the capital reserve. Goodwill is not recognized. Comparative figures restated as it combination happens from the beginning. So this is most important. So comparative figures has to be done assuming that it was combination was affected from the beginning. So basis, if we could try to compare this with the acquisition method. So let's just quickly look at some of the different area of difference between the pooling method and the acquisition method. So pooling method is applied to entity which has the common control. Acquisition is a normal acquisition. Asset valuation is being done at the carrying value. It is done as a fair value in the acquisition method. Goodwill is not recognized. It was recognized or in the acquisition method. Reserve, everything differences go to the capital reserve. Goodwill is there in the acquisition method. Comparatives needs to be restated whenever we are doing the acquisition through a pooling method, but it is not restated because this is a pure new business from the acquirer standpoint of view. For a pooling method, it has to be done because it is just the arrangement. It's not like business transfers. It's just combination of two entities which was having the common parent, and hence it requires the comparative figures because whenever we are reporting at the consolidated level at the parent level, then it needs to have the comparative for the previous years as well. So this is a quick update on the pooling method and how it is being differentiated from the acquisition method. So we'll move to the next slide then. Okay, now we'll talk about the subsequent measurement. So typically, whenever the accounting standard applies, it has two concepts wherein we have to do the original recognition and the original measurement, which is like initial recognition and the initial measurement. And then at each reporting date, we have to do the subsequent measurement. So while each accounting standard has its own set of the subsequent measurement concept, there are certain specific items on which Ind AS 103 has its own understanding and the concept of subsequent measurement. So what does this standard say is that in general, an acquirer shall subsequently measure and account for the asset and liabilities assumed or incurred equity instrument issued in the business combination in accordance with the other applicable Indian accounting standard for those items, depending on the nature. So which is that once the initial recognition has happened at the fair value, any subsequent measurement would be happen as per the applicable standard. However, there are certain classes, certain exceptions to that. What are those? So when we talk about the reacquired rights, so a reacquired right recognized as an intangible asset shall be amortized over the remaining contractual period of the contract as is was granted. So basically, a reacquired right is when the right was which was given to the acquiree, what was again get back to the acquirer, and then it let's say it has a period attached to it, then we have to amortize that particular reacquired right over the remaining contractual life of that particular right. So for contingent liabilities, it is the option wherein it's not an option, basically it's mandatory that it has to be measured at the higher of the two, which is the amount which is being assessed as per the provision of Ind AS 37, or the amount which was originally recognized, less if at all any amortization has been done to them. So higher of two would be recognized as the or the measured as the contingent liability. Then third one is the contingent consideration. So typically contingent consideration is an additional payment which acquirer has to pay to the acquiree, and that is contingent on the happening of an event. And if at all the way in which it has to be paid to the acquiree, if it is a liability, then it has to be remeasured at the at each reporting date if it has not been paid, and then any gain or loss on that would be transferred to the profit and loss. So it is recognized as the fair value on the acquisition date, and it classifies a liability and is remeasured at each reporting date with changes recognized in the profit and loss. So if it has been settled, then it is one-time settlement is done. But if it is not settled, then each reporting date, and if it has been agreed to be paid as a liability rather than an equity, then it would require remeasurement. But if it has been agreed that it would be managed through the equity by issue of the equity, then in that case there is no remeasurement. The amount that has been credited at the time of the initial recognition or the initial measurement, that will remain same. So typically, a subsequent measurement is largely all the assets and liabilities that has been acquired, or the principals of the respective Ind AS would treat them. But for these three cases, we require reacquired rights, contingent liabilities, and the contingent consideration. There's a separate rule which is being mentioned by Ind AS 103. So we'll move to the next slide then. Okay, now we'll talk about another concept which is called reverse acquisition. So, reverse acquisition means a situation when the entity that issues the shares is basically is the legal parent, is actually the accounting acquiree, and the entity whose shares are acquired, which is the legal subsidiary, is the accounting acquirer. This is a typical scenario when the small entity is acquiring the large business, and though on the papers the legal acquirer is the small company, but the accounting acquirer is the large company. And this typically is a kind of a scenario when uh, a small company gets merged with the large company, or privately held large company wants to get themselves listed without following the IPO route. They follow these kind of methods through which they can become listed. So when is this kind of scenario happens? When a smaller company takes over the larger company in listing arrangement and in restructuring or holding company formations. So what we have done, we have created an example to demonstrate that how this reverse acquisition happened. So we have taken a concept wherein there are two companies, small company which is legal parent, and this company is Alpha Limited, which is listed. We have another company which is the larger private company which is non-listed, which is Beta Limited. The net assets of the fair value of the Alpha is 100 crore, and the net assets on the fair value of Beta is 500 crore. So existing shareholders are the Alpha shareholders, existing shareholder for the Beta shareholders. So now transaction happens wherein Alpha Limited acquires the Beta Limited. Alpha issues the shares worth rupees 400 crore to the Beta shareholders, and Alpha issues shares to the Beta shareholders, and after issue, Beta shareholders hold 80% in the Alpha Limited. So which means that though on the legal formalities or legal substance, the acquirer is Alpha Limited, but in the accounting scenario wherein accounting happens, or the accounting acquirer is the Beta Limited. So what we have to do, so legally Alpha Limited acquire Beta, but economically Beta controls the combined entity, and therefore Beta is the accounting acquirer. So what we have to do, we have to determine the consideration. So accounting entry will be happen in the books of Beta Limited. Although Alpha Limited issues share, the consideration is the measure the fair value of the Alpha shares. So in this case, the Alpha issue share worth is 400 crore. So the fair value of Alpha shares to be issued is 400 crore. The net asset value of the Alpha Limited is 100 crore. So which means that what we have to do, we have to calculate the goodwill or the capital reserve. So consideration for the fair value of the Alpha share is 400. Fair value of the net assets of the Alpha is 100. The total goodwill is 300. The accounting entry for this goodwill is going to happen in the books of Beta Limited. This is despite the fact that Alpha Limited has issued the shares. And the Alpha Limited is the legal acquirer, but for accounting purposes, the legal acquirer is Beta Limited. So accounting entry at the acquisition date is assets of the Alpha Limited will be 100, goodwill will be 300, and two shares would be created with the 400. Now, when we look at the presentation, the financial statements will be presented as if Beta Limited is continuing. Legal structure is the Alpha Limited. Comparative financial would be that of the Beta Limited. So, which means that in this way, Beta Limited got the access to the share market without actually following the IPO route. So this is the kind of a typical scenario when a large company merged with the smaller company, and then post merger, the large company become the major shareholder or the controlling interest passes on to the accounting acquirer, which is not the which is the legal acquiry. So accounting acquirer is a legal acquiry, and the legal acquirer is the accounting acquiry. So this is a situation in which reverse acquisition happen, and this is a typical scenario, and it has to be understood very clearly that how this kind of route is being adopted whenever a large private firm wants to get their shares listed in the listed company in the stock exchanges. So we'll move to the next slide then. Okay, now we'll quickly talk about the presentation and disclosures. So for presentation disclosures, the disclosure is required to ensure that the name and the description of the inquiry is there, acquisition date, consideration transferred, recognized amount of the asset and liabilities, and finally the goodwill that needs to be recognized. So all this is required as a part of the disclosure of Ind AS 103. So we'll move to the final slide, which is the comparatives between IFRS 3 and the Ind AS 103. Okay, so this is the final slide wherein we are going to show the comparison between Ind AS 103 and the IFRS 3. Now, acquisition method, it is same. There is no difference as such. uh, Fair value approach is same. Common control combination is being covered separately in Ind AS 103, as we have seen that we have covered two separate concepts, which is acquisition and the pooling of interest method. But IFRS 3 exclude that pooling of interest method. Recognition of the bargain gain is being transferred or treated in the OCI, but it is treated as in the PNL for the IFRS. So these are two differences with respect to the IFRS 3 and the Ind AS 103. So we'll move to the end of this session. Now we'll move to the final thank you slide. So this was the complete and practical understanding of Ind AS 103 business combinations. So we learned how to identify a business, apply the acquisition method, recognize and measure assets and liabilities at fair value, and compute goodwill or bargain purchase gain. We also discussed special situations like common control combinations, step acquisitions, reverse acquisitions, contingent consideration, and reacquired rights. Once you understand this standard, you can confidently handle mergers and acquisition accounting both in exams and in real corporate financial reporting. Thank you for staying with me till end. If you found this session valuable, do share it with your friends and colleagues. And we are going to come up with another Ind AS very soon. Thank you and stay connected.